7 costly money mistakes that steal decades of your life. Most people believe wealth is built by discovering the right opportunity, the perfect stock, the perfect moment, the secret shortcut no one else knows. That belief feels logical, and it's completely wrong. In reality, that mindset is the first and most dangerous trap in personal finance. After decades of observing how money is actually made and lost, one truth becomes impossible to ignore. Wealth is not created by brilliance. It is created by avoiding predictable mistakes. There is no hidden formula, no magic system, no guaranteed shortcut. There is only a short list of common behaviors that quietly destroy financial progress, not overnight, but slowly, over years and decades. Most people don't notice these mistakes while they're making them. They only recognize them later, when time is gone and options are limited. The tragedy is that these errors are not rare. They repeat across generations, across markets, across economic cycles. Different decade, different asset, same outcome. People chase excitement instead of discipline. They confuse movement with progress. They mistake complexity for intelligence, and little by little, their financial future erodes. The uncomfortable truth is this: you don't need exceptional intelligence to build wealth. You don't need insider access. You don't need perfect timing. What you need is restraint, the ability to say no to obvious temptations, the patience to ignore noise, the discipline to avoid decisions that feel good now but cost you later. Money is rarely lost in one dramatic moment. It is lost through small, repeated choices that seem harmless at the time. Overtrading, overconfidence, chasing trends, ignoring risk, letting emotions replace logic. Avoiding these mistakes doesn't guarantee instant success, but it dramatically increases your odds over time. This approach isn't exciting. It won't impress people at parties. It won't produce viral screenshots or overnight results. But it works. Not occasionally, not when markets are calm, but consistently across booms, crashes, and uncertainty. This is not hype, this is not prediction, this is not motivation. This is about principles that survive when everything else fails. If you learn to avoid the mistakes that quietly steal decades of your life, time will do the rest. And time, when used correctly, is the most powerful financial advantage you will ever have. Mistake number 1: learning only from your own mistakes. Relying solely on personal experience to learn financial lessons is one of the most expensive decisions a person can make. Experience is often praised as the best teacher, but in investing and money management, it is also the slowest and most costly one. No individual has enough time, capital, or emotional resilience to personally experience every major financial mistake. By the time those lessons are learned firsthand, the damage is often permanent. Years are lost, opportunities disappear, recovery becomes difficult. Fortunately, history has already done much of the work for us. Every major market crash, speculative bubble, corporate collapse, and financial scandal has been carefully documented. These events are not random accidents. They follow recognizable patterns that repeat across decades and centuries. Only the labels change: excessive use of debt, overconfidence during periods of growth, complex financial structures designed to hide risk, and the dangerous belief that this time is different. These patterns continue to repeat because human psychology remains unchanged. Fear and greed operate the same way today as they did 100 years ago. Technology evolves, markets modernize, and products become more sophisticated, but the behavior driving financial decisions stays remarkably consistent. Studying past failures is not pessimism. It is preparation. Learning how others lost money teaches you what to avoid long before you are personally tested. It allows you to recognize warning signs early before enthusiasm turns into panic and confidence turns into regret. Reading about financial disasters compresses centuries of lessons into a few focused years of study. You gain insight without paying the price yourself. You learn how leverage destroys portfolios, how speculation disguises itself as innovation, and how intelligent people convince themselves to ignore obvious risks. History also provides context. It reveals how easily rational thinking collapses during booms and how quickly discipline disappears when prices rise. It shows that the most dangerous periods are not recessions, but times of widespread optimism. Ignoring this historical record does not make someone independent or forward-thinking. It makes them vulnerable. Those who dismiss past failures often believe they are different, more informed, more cautious, more capable. In reality, they are repeating the same errors under new conditions, unaware that the outcome is already written. Financial success is rarely about discovering something new. It is about recognizing what has already failed and refusing to participate again. By learning from the mistakes of others, you protect your time, your capital, and your future. And in the long run, avoiding major mistakes matters far more than making brilliant decisions. Mistake number 2: investing in things you don't understand. Complexity is often mistaken for intelligence. In modern investing, the more complicated something sounds, the more credible it appears. Technical language, sophisticated models, and elaborate explanations create the illusion of expertise. But complexity does not reduce risk, it often hides it. True investing is built on clarity. If you cannot clearly explain what you own, how it makes money, and why it should still exist 10 years from now, you are not investing, you are speculating. Speculation relies on hope. Investing relies on understanding. Many people unknowingly reverse these two. They spend hours comparing reviews before buying a small household item, yet commit significant amounts of money to assets they cannot describe in simple language. The contradiction is striking and expansive. This behavior is driven by confidence borrowed from others, a recommendation from a friend, a confident voice online, a complex explanation that sounds convincing enough to quiet doubt. But borrowed confidence is fragile. When prices fall or volatility rises, understanding is the only thing that prevents panic. Missing a profitable opportunity is survivable. Losing money in something you never understood is avoidable. Every major financial disaster shares a common element. People invested in products they did not fully comprehend. Layers of leverage, structures designed to appear sophisticated, instruments whose risks were buried beneath technical terminology. When clarity disappears, accountability follows. Understanding an investment does not require advanced mathematics or insider knowledge. It requires simplicity. If an asset cannot be explained without excessive jargon, it is often because the underlying economics are weak or unstable. A useful test is this. Can you explain your investment to someone with no financial background, clearly and honestly in 1 or 2 sentences? If not, your confidence is likely based on price movement rather than substance. Another important distinction is between why something might increase in price and how it actually generates value. Price appreciation alone is not a business model. Sustainable investments produce cash, serve real demand, and operate within understandable systems. The strongest investments tend to be boring. They sell familiar products. They operate in stable industries. They make money in transparent ways. Complexity attracts attention. Clarity builds wealth. When investors chase complexity, they often believe they are being innovative or forward-thinking. In reality, they are accepting risks they cannot measure and outcomes they cannot control. Clarity protects capital because it creates patience. When you understand what you own, short-term fluctuations matter less. You are less likely to panic, less likely to chase trends, and less likely to abandon sound decisions at the worst possible moment. Investing is not about knowing everything. It is about knowing enough to avoid what you do not understand. In finance, simplicity is not ignorance. It is discipline. And discipline, over time, is what separates speculation from lasting wealth. Mistake number 3. Being in a hurry. Wealth does not respond to urgency, it responds to time. One of the most damaging beliefs in personal finance is the idea that success must happen quickly. This mindset pushes people toward constant action, buying, selling, adjusting, reacting under the assumption that movement equals progress. In reality, the largest financial gains rarely come from clever timing or frequent decisions. They come from allowing compounding to work without interruption. Compounding is powerful precisely because it is slow. It builds quietly, often invisibly, until time magnifies small advantages into meaningful outcomes. Impatience breaks this process before it has a chance to work. Short-term excitement creates long-term damage. Overtrading erodes returns through fees and taxes. Chasing trends increases exposure at the worst possible moments. Excessive risk invites permanent losses that compounding cannot repair. Slow progress feels uncomfortable, it lacks drama. It does not provide constant validation. But impatience is far more expansive than boredom. The goal is not rapid wins. The goal is survival. Staying solvent long enough for compounding to take effect matters more than any single opportunity. Those who remain invested, disciplined, and patient often outperform those who appear more active but are quietly undermining their own results. Time favors consistency, not urgency. Mistake number 4. Confusing diversification with understanding. Diversification is often presented as a universal solution to risk. While spreading exposure can be useful, owning many assets does not reduce risk if none of them are understood. Excessive diversification often becomes disguised indecision. When portfolios grow to complex responsibilities, investors stop evaluating individual holdings and begin relying on assumptions that professionals know better. That complexity implies safety, or that quantity compensates for lack of clarity. Understanding reduces risk far more effectively than accumulation. If you cannot follow, explain, and evaluate what you own, you are not managing risk, you are outsourcing thinking. And outsourced thinking almost always comes at a cost, whether through fees, underperformance, or unnecessary complexity. For investors unwilling or unable to deeply study individual businesses, simplicity is often the superior choice. Broad market funds provide diversification without the burden of constant evaluation. They remove the need for prediction and reduce the risk of poor decisions. Complex portfolios require constant attention. Simple portfolios require discipline. There is no advantage in owning assets you cannot monitor or assess. In such cases, Fewer well-understood positions often outperform many poorly understood ones, not because they are inherently safer, but because they allow for better decisions over time. Simplicity is not weakness, it is structure. In investing, clarity enables patience, and patience enables compounding. Together, they form the foundation of durable wealth. Mistake number 4. Confusing diversification with understanding. Diversification is often presented as the ultimate solution to investment risk. The advice sounds responsible. Spread your money, avoid concentration, and protect yourself from uncertainty. While diversification has a role, it is frequently misunderstood and misused. Owning many assets does not reduce risk if none of them are understood. In practice, excessive diversification often becomes disguised indecision. Instead of making deliberate choices, investors accumulate positions simply to feel safer. The result is a portfolio that looks sophisticated on the surface but lacks any real conviction beneath it. Risk is not reduced by quantity alone, it is reduced by knowledge. When investors hold dozens of stocks, funds, or financial products they cannot clearly explain, they are no longer managing risk, they are outsourcing thinking. That outsourcing usually comes at a cost: higher fees, lower returns, and diminished accountability. A portfolio filled with unfamiliar assets creates the illusion of control while removing the ability to make informed decisions. When markets become volatile, confusion replaces clarity. Investors are left unsure what to hold, what to sell, and why they own anything at all. Understanding is the foundation of intelligent diversification. Each investment should serve a clear purpose. You should be able to explain what the asset does, how it contributes to your portfolio, and under what conditions it might fail. Without that understanding, diversification becomes a defensive habit rather than a strategic choice. This is why many investors would be better served by simplicity. For those unwilling or unable to deeply study individual businesses, simple broad market funds often outperform complex portfolios over time. They provide exposure to economic growth without requiring constant analysis, predictions, or adjustments. They reduce decision-making errors by removing unnecessary complexity. Complexity demands attention. Simplicity demands discipline. Neither approach is inherently superior, but mismatch is costly. A complex portfolio without understanding is dangerous. A simple portfolio held with consistency is often powerful. Simplicity is not weakness, it is focus. It allows investors to remain patient, avoid emotional decisions, and stay aligned with long-term goals. It minimizes unnecessary activity and reduces the temptation to react to short-term noise. True diversification is not about owning everything. It is about owning what you understand and nothing more. When clarity replaces confusion, decisions improve. When decisions improve, outcomes follow. In investing, discipline outperforms cleverness, and understanding will always be a stronger form of protection than excess diversification. Mistake number 5. Ignoring fees and taxes. Small percentages compound negatively. In investing, the most dangerous costs are not dramatic losses or obvious mistakes. They are the quiet, recurring expenses that feel insignificant in isolation but become devastating over time. Fees, frequent trading, and unnecessary taxes steadily drain wealth year after year, often without attracting attention. Because they are subtle, they are underestimated. A 1% fee does not feel threatening. It sounds minor, almost harmless. But compounding works in both directions. Just as returns grow over time, costs do as well. When fees are applied annually, they compound against you, silently reducing the capital available to grow. Over a lifetime, the difference between low-cost investing and expensive management can amount to hundreds of thousands, or even millions of dollars lost. This loss does not appear as a sudden decline. It shows up as missed potential. The money is never seen, never earned, and never recovered. Fees are only part of the problem. Frequent trading introduces additional friction, commissions, bid-ask spreads, and market impact. More importantly, it triggers taxes. Every sale creates a taxable event, reducing the amount of capital that remains invested and able to compound. Short-term decisions are often taxed at higher rates, turning activity into a penalty. The more frequently capital moves, the less time it has to work efficiently. This constant friction erodes returns, even when individual trades appear successful. Efficient investing is not about activity. It is about minimizing friction. Many investors focus obsessively on returns while ignoring costs. Even though costs are the one variable fully within their control, markets fluctuate, outcomes are uncertain, but fees and taxes are guaranteed. Reducing them produces a permanent advantage. Low-cost structures allow more of your capital to remain invested. Tax efficiency allows gains to compound uninterrupted. Together, they create an environment where time works in your favor rather than against you. This is why simplicity often outperforms sophistication. A straightforward, low-cost approach held consistently can surpass complex strategies burdened by fees and constant adjustments. The most effective investors are not those who trade the most or chase marginal gains. They are those who protect their capital from unnecessary leakage. Wealth is not only built by what you earn, it is preserved by what you avoid losing. By respecting the long-term impact of fees and taxes, you shift the balance back in your favor. You allow compounding to work as intended, quietly, steadily, and powerfully. In the end, efficiency is not about doing more. It is about letting less interfere. Over time, that discipline can make the difference between average results and lasting wealth. Mistake number 6, letting emotions drive decisions. Fear and excitement are terrible financial advisors. Markets do not move based on logic alone. They move on human emotion, optimism, anxiety, greed, and panic. When investors allow those emotions to dictate decisions, they consistently act at the worst possible moments. Fear causes selling at lows. Euphoria causes buying at highs. These reactions feel justified in the moment because they are reinforced by headlines, social pressure, and short-term price movements. When markets fall, fear feels rational. When markets rise rapidly, excitement feels intelligent. But both emotions distort judgment. The market does not reward emotional intensity. It rewards patience and consistency. Most financial damage does not come from bad assets. It comes from bad timing, driven by emotional responses. Investors abandon long-term plans during temporary downturns, locking in losses that could have recovered with time. Others chase momentum after prices have already risen, paying premiums for assets that offer little margin of safety. Emotion feels urgent. Discipline feels boring. And boredom is precisely what successful investing often looks like. Rules written during calm moments matter most during chaos. A well-designed plan anticipates volatility, uncertainty, and discomfort. It assumes markets will decline. Sometimes sharply, it assumes periods of underperformance. Without predefined rules, emotion fills the gap, and emotion is unreliable. Discipline creates distance between feeling and action. It prevents temporary fear from becoming permanent loss. It prevents excitement from turning into overexposure and excessive risk. The most effective investors are not emotionally detached. They are emotionally prepared. They accept that discomfort is part of the process and design systems that prevent impulsive decisions. Markets fluctuate. Emotions spike. Time smooths both. Long-term wealth is built by remaining invested through cycles, not by reacting to them. Every major market decline in history has eventually recovered. Those who stayed disciplined were rewarded. Those who reacted emotionally often missed the recovery entirely. This does not require exceptional intelligence. It requires restraint. Restraint to do nothing when panic demands action. Restraint to avoid action when excitement tempts risk. Over time, this restraint compounds just like capital. Emotional control is not about suppressing feelings. It is about refusing to let them dictate decisions that should be governed by logic, structure, and long-term objectives. In investing, the greatest edge is not superior information or faster execution. It is the ability to remain calm while others react. Because in the end, wealth is not built by intensity. It is built by discipline, applied consistently, especially when it feels hardest to do so. Mistake number 7, quitting too early. This is the most destructive mistake of all. Not because it involves poor strategy or lack of intelligence, but because it erases the benefits of everything done correctly before it. Compounding is slow at first, painfully slow. In the early years, progress feels invisible. Effort appears disconnected from results. Savings grow, investments are made, discipline is maintained, yet the numbers barely move. This phase tests patience more than knowledge. Many quit during these quiet years. They assume something is wrong, that the strategy failed, that others have found faster paths. In reality, they are standing precisely where compounding always begins. Wealth grows exponentially, not linearly. That means the most meaningful progress happens late. The curve stays flat for years before it rises sharply. Those who leave early experience only the effort, never the reward. The breakthrough comes after endurance, not before it. History repeatedly shows that long-term wealth is rarely built by a sudden insight or perfect timing. It is built by people who stayed consistent through boredom, doubt, and delayed gratification. They did not outperform because they were smarter. They outlasted. Consistency matters more than brilliance. Endurance matters more than talent. Quitting early resets the clock. Every restart forces you back to the beginning of the curve, where progress is slowest. This is why frequent strategy changes and abandonment are so costly. They prevent compounding from ever gaining momentum. Time is not neutral. It either works for you or against you. Those who remain invested allow time to absorb volatility, smooth mistakes, and multiply small advantages. Those who quit surrender that power just before it becomes visible. This is not an argument for stubbornness. It is an argument for commitment to sound principles. The key is not blind persistence. It is patient persistence, guided by logic, not emotion. The hardest phase of wealth building is not the beginning. It is the middle, where nothing seems to happen. This is where discipline separates from distraction, where quiet consistency outperforms constant optimization, where most people stop and a few continue. The difference between financial struggle and financial independence is often not effort or intelligence. It is staying long enough for compounding to reveal itself. Because wealth does not reward those who rush, it rewards those who remain. And the ones who stay are almost always surprised by how powerful slow becomes once they finally let time do its work. If this approach resonates with you, consider subscribing. This channel is not about chasing the next hot stock, viral trend, or overnight wealth scheme. It is about understanding how money actually works, slowly, deliberately, and reliably. Here we focus on timeless financial principles, the strategies that have consistently built wealth for decades, and the lessons that most people overlook. We do not promise shortcuts, magic formulas, or instant results. Instead, we explore ideas that work quietly, consistently, and over time, the kind of decisions that may feel boring in the moment but compound into lasting financial freedom. By subscribing, you join a community of thinkers who value patience, discipline, and clarity over noise and hype. You will learn how to avoid costly mistakes, make informed choices, and stay on track through market cycles, volatility, and temptation. Investing in wealth building are long-term games, and success belongs to those who understand the rules and stick with them. If you are ready to focus on what truly matters, hit the subscribe button, follow along, and let these principles guide you calmly, consistently, and without unnecessary risk.